Welcome to FXTech's weekly analysis of the EUR/USD. This report covers the trading week from December 1st to December 5th, 2025. We'll break down the key market drivers, technical levels, and provide our outlook for the week ahead. Stay tuned for a detailed look at the fundamental and technical factors shaping the world's most traded currency pair. This analysis was prepared on December 8th, 2025. This week, the EUR/USD extended its impressive winning streak to 9 consecutive days, gaining approximately 1.2% in the process. The rally was fueled by a softer US dollar and growing expectations of a Federal Reserve rate cut, especially after PCE inflation came in lower than expected at 2.8%. The market is now in a consolidation phase, with traders cautiously bullish as they await the critical Fed decision and Friday's PCE data release. Let's look at the key technical levels from this week. The pair traded within a tight 80 pip range between 1.1600 and 1.1680. The 1.1600 level has acted as a key psychological support zone, while the 1.1660 to 1.1680 area, which includes the 100-day simple moving average, has proven to be a formidable resistance. A breakout above this level could target 1.1730, a level where sellers were active in October. The tight price action suggests the market is waiting for a catalyst. The EUR USD's 9-day winning streak is a significant technical development. The pair added another 20 pips early Wednesday, demonstrating steady momentum in what can be described as classic December FX energy, a slow, grinding climb. This rally, fueled by a softer dollar and Fed rate cut hopes, has traders cautiously optimistic. However, this consolidation is a test of patience, and any surprise dollar strength could quickly unwind these gains. The primary driver of the euro's strength has been the expectation of a Fed rate cut. This was reinforced by PCE inflation data coming in at 2.8%, lower than anticipated. With consumer spending stalling, traders are now pricing in a 25 basis point cut at the December meeting with over 90% conviction. All eyes are now on the Fed's preferred inflation measure, the PCE data, to be released this Friday, December 5th. Softer data will likely fuel further euro strength. The 1.1660 level is the key battleground for the EUR/USD. This level, where the euro failed to break in mid-November, also coincides with the 100-day simple moving average. A clean breakout above this resistance could open the door to the next target at 1.1730, where sellers stepped in on October 17th. However, a failure to break this level could trigger a reversal and a test of lower support levels. The market's indecision is palpable ahead of the Fed's decision. In the short term, the EUR/USD is consolidating within a tight 80 pip range between 1.1600 and 1.1680. The bias remains bullish, but the market is in a holding pattern ahead of the Fed's decision. The 1.1600 level is providing solid psychological support, while the 1.1660 to 1.1680 area is a confluence of technical and moving average resistance. This tight price action suggests traders are waiting for a clear macro catalyst before committing to a direction. Looking at the midterm, the EUR/USD has a bullish structure within a wider 300 pip range between 1.1500 and 1.1800. The strong uptrend from the November lows suggests a fundamental shift in sentiment towards the euro, largely driven by Fed rate cut expectations. The 1.1500 level is a critical psychological support, while the 1.1730 to 1.1800 area represents a major multi-month resistance zone. The midterm bias remains bullish as long as the 1.1500 support holds. Several critical catalysts will shape the EUR/USD's direction in the coming days. The most immediate is this Friday's PCE data, the Fed's preferred inflation measure. This will be followed by the highly anticipated December FOMC decision, where a 25 basis point cut is expected. Traders should also monitor the economic calendar for other data releases and any hawkish or dovish signals from Fed officials. Key risks include a surprise dollar rally or stronger than expected economic data that could delay the Fed's easing cycle. Our investment thesis is to maintain a bullish bias on EUR/USD while respecting the current consolidation phase. We recommend buying dips towards the 1.1600 support zone and taking profits on rallies towards the 1.1660 to 1.1680 resistance. A breakout above 1.1680 would target 1.1730. For risk management, a stop loss below 1.1550 is advised. The key is to watch the upcoming PCE data and the Fed's decision, as a break of the 1.160 support would invalidate the bullish outlook.